Right now, for a closer look at this morning's CPI number and implications for the Fed, we want to bring in former Cleveland Fed President Loretta Mester. She's a senior scholar at Princeton's Griswold Center, adjunct professor of finance at UPenn's Wharton School, and a CNBC contributor. And Loretta, did the number today change anything about how you see the economy? It was pretty much in line in many ways.
Yeah, I mean, it didn't really change anything for me. It came in along expectations, which was a good thing. And we saw some components, including the services X housing, core services X housing actually looked better than it had before because housing looks pretty good. So those are good things, but really it's old news.
Yeah.
And what we really need to parse is what the war is going to mean for inflation going forward and also for the real side of the economy. So I think that's what the Fed is going to have to focus on. It was the CPI good. We have it as a baseline, but it doesn't really tell you much about what trend we're going to see in the inflation numbers going forward.
Correct. We were talking about how so many of the numbers that we've gotten in recent months are outdated before we get them, whether it was the government shutdown, whether it was the news with tariffs last April. What are you expecting based on what we've seen? Obviously, we don't know the outcome of this war. We don't know how long oil prices are going to remain elevated. But how would you go about it if you were still sitting at the Fed?
Right. Well, certainly you have to take into account different scenarios for how the war will play out and how long and how high energy prices will be elevated. And that's going to be key for determining really how the Fed might want to react. They're going to have to balance both sides of their mandate, employment and inflation. The context usually is you'll look at a model and it'll basically tell you that you can look through oil price shocks because they don't really feed through to core inflation, and that tells you more about the trend going forward in inflation. And frankly, usually the oil price shock then has a negative for growth and employment, which takes a little bit longer to play out. But I think in today's world, that context really needs to be thought about a little bit differently. One, the growth impact of the oil price shock will probably be less because we now export energy. We're not an importer, and we're more efficient at using energy. So those probably mean that the effect on the growth side will be less than usual, certainly less than in the 70s and 80s. But on the inflation side, I think the committee has to be very careful because it is a supply constraint when you have high oil prices and disruptions in getting energy. It's going to really be about balance of demand and supply. And we do know that we have a lot of fiscal stimulus in the pipeline. So I think they're going to have to focus on, again, making sure that they don't do the same thing that we did before, which was think that we could look through this as a one-of increase in the price level and have it be sort of ignored when it could actually lead to more lasting inflation. And inflation expectations remaining stable will be important. And unfortunately, high gasoline prices is really salient for people's perceptions of inflation. If people see gasoline prices going up and staying up, that'll probably feed into what they expect inflation to be going forward. And that'll make it much harder for the committee to really ignore that oil price shock. So I think in the near term, certainly they're on hold. And perhaps for the longer term, they may have to be in hold if things stay reasonably well on the demand side of on the employment side of the mandate, and we see these higher inflation numbers.
So I think what you just said in a nice way is the Fed is not going to forget the lesson that transitory inflation kind of played out in the not too
I don't think that they'll forget that because I think I was on the committee at the time, and it was an error. We didn't really perceive the effect of that, having that supply and demand imbalance. At the moment, I think they're in pretty good place, right? They've gotten in, their Fed funds rate is probably a good place to be able to wait this out. So I give them credit for that. They're in a good place. They can wait a while longer. We don't see, a big weakening in the labor market. We could eventually see that, but we don't see that right now. We have, unfortunately, softening in the labor market, but that really reflects somewhat what's going on in the supply side, not the demand side. Monetary policy really can't address that. and we have the inflation numbers at a reasonable place, but still being above the mandate for 5 years means that inflation expectations are going to be less stable, less anchored than they would have otherwise be. And that's why I think the focus has to be on that inflation side, at least in the near term. If we do get a development that shows more deterioration in the labor market or even financial instability, then that might change the calculus here. But at this point, they're going to be on hold.